Hi everyone, welcome to our bi-weekly Twitter Spaces. Uh, Last time we were talking mostly about the patience and not being short, and patience actually paid off. Market is higher compared to where it was 2 weeks ago. So we will start very soon. Brian, I will make you a host just in case. Done. Okay, so today I'm sure we have a lot to talk about, and today we will start from Matt. So first of all, hi everyone. Thanks for joining. Thanks for being with us. Hope these 2 weeks were profitable, or at least you risk managed it well. Okay, so this time we will start from Matt. Hi Matt, how are you doing? What you are trading and what you see in the market?
Hey guys, hey Vi and everyone. I've basically kind of taken the last week and a half and reduced my positions greatly, both on the long and the short side. I also took a lot of fixed income off the table, um, and as well as gold. So I feel like I've got less positions now than I've had in years. Just kind of sitting, waiting, and playing a game of patience, which is kind of rare for me because one of my bad habits that I'm attempting to overcome is over trading and feeling like I need to be in a position when I can just sit in cash and wait for the right moment. And one of the things that led me to that was it's a book that we've all talked about and Vice sent around is John Carter's Mastering the Trade, and it really goes over the need for patience and the need to just sit on your hands until the setup is perfect, and maybe not perfect but a little bit, just not needing to be in trades. So my positioning now, for the most part, is overall I'm still extremely bearish on the long term outlook when it comes to equities. I know Brian is really pushing fixed income in terms of starting to add and build positions on the duration side of that. I'm not quite there yet. I'm not against it. I do have some LQDH on the long side with a very tight leash. Probably my greatest position to this day still is short junk bonds, and I've been trading in and out of that quite successfully. So the ticker is SJB. It's the inverse product for HYG, I believe. Um, and then beyond that, I've just got a limited number of longs. A lot of those are on Brian's list in terms of the strongest, the signal strength being the strongest, including Grocery Outlet, Geo, Monster, MNST. I've started in the last week accumulating positions in China on the individual side, EDU, FUTU, and on the ETF side, FXI and KWeb. And I think that's probably where I'm going to stick and just build those up over time as they pull back. And even if they don't, I'll just continue to just progressively add to those. On the short side, I've had just a number of core shorts that I've just been sticking with retail stocks, XRT on the ETF side, Macy's on the short side, which has been very kind to me, as well as Ralph Lauren. Kroger, I think I've mentioned at least to Brian and Vi and Raphael that I am trading a pair where I have long Grocery Outlet and short Kroger, which has turned out to be a fantastic trade. And then beyond that, just like sometimes I'll just trade within a day and get in and out. And I did that yesterday. I did it today, and with the number of positions I have being as low as they are, it's making it really easy to focus. And other than that, I'm just kind of playing the wait and see game. I think right now we're just in a period of doldrums until the July 4th holiday clears, which I think is keeping me on the sideline as well until next, and that's even regardless of what economic reports might come out. I think everyone's on vacation right now, and they're going to be there until next Tuesday, Wednesday. And even next week might be a light week in terms of volume and the number the activity in the market and the action. So that's kind of where I sit in the nutshell. And again, I'm just waiting and seeing, just being very patient, and eventually I'll go in and just go crazy with shorts again. But right now I'm sitting tight.
Nice. We'll talk about China and gold a bit later, but yeah, I'm also about 80% cash, mostly USD, because from risk management and risk reward perspectives, not a lot signals for now. All I see is a chop. Okay, so let's move to Brian. Brian, hi, and what you're trading and what you see in the market.
Hey there, Vi. Hey, Matt. Hey, Ralph. Yeah, so for me, the last 2 weeks have been pretty difficult. Last meeting, I was coming here, I think it was right at Fed Day, maybe right after the close of Fed Day, and I was talking about looking long, and that worked for like 2 days up until the Fed Day, and then the day after, you had that the Swissies hiking rates overnight and just slapped the longs right in the face and put them right back down to the 3,600 range. And I guess mentally and just portfolio wise, I wasn't quite prepared for that move. Maybe I got a little too comfortable, thought the longs were in the bag based on how we reacted after the Fed meeting and going into the OPEX that Friday. And so got a little comfortable, and then I guess personally just made a mistake after that. And when the everything went down after the Swissies hiked, I pretty much jumped ship on my long case. So that was a big mistake. Kind of jumping ship there, because then right after that we kind of started basing in the 3,600 range, and then went up, and then had that pretty large squeeze last Friday. So unfortunate there, missed a trade. Didn't take really many heavy losses, but missed some good gains in that move. And then coming out of that squeeze last Friday, I was just really patient, getting back on the short side. When you have a big fat squeeze like that on Friday, me personally, typically what starts on a Thursday or a Friday, especially into an OPEX, will continue on a Monday. And so, yeah, Monday we did close red, but we opened pretty well in the green. So there was an opportunity there to kind of wait and watch on the shorts. And then the key level out of that into Monday and Tuesday was 3,900 gamma flip. And then once we were able to sustain a break of that over just 2 days, all it took to break there, we then had a pretty good day on the short side yesterday. And so now what I'm looking at here is some things have really changed from my perspective in the market over the last 2 weeks. What you had in the drawdown leading up to the Fed meeting, and then sort of started to continue to have a small bounce afterwards with stocks, is just the breaking down of the commodity complex broadly. I mean, oil's put in a little bit of bounce here. I know in MFR it's about neutral right now, and it could kind of go either way, but otherwise, commodity-wise, copper, all the ags, natural gas are just bearish trend, not looking good. You've got the DBC and the DBA, both bearish trend within commodities there. Actually, I think maybe DBC actually went to neutral today, but it was neutral the morning today, but then down again today. So we'll see what that refresh is. But in general, commodities broadly aren't along here unless you wanted to go long oil against something, but I'm not sure if that's really the play considering where we're going from a recession perspective. And so this breaking down of the commodity complex has, in one way or another, fueled the pressure that we've seen in bond yields coming into this week. And then what I identified over the weekend coming into this week is that we had some pretty consecutive back-to-back catalysts starting on Tuesday, or actually starting on Monday, that I thought should continue to pressure bond yields. And so that was going to be durable goods, consumer confidence on Tuesday, which printed a cycle low, Powell yapping this morning. Then tomorrow we have the PCE number and the ISM number on Friday. The PCE number tomorrow, I mean, it could go either way. Not really sure what it's going to print. Not sure how much what it prints really matters in relation to bond yields or stocks. It could be a nothing burger. We'll just have to see. Like Matt said, I mean, so many people are on vacation right now. I'm not sure how much that print really matters. I'd say ISM on Friday is probably more important. That one's a lot easier to trade because ISM is on just a slow tick downwards to new cycle lows, and based on consumer confidence too, I'd expect that to follow suit and continue there. And so, nonetheless, like we have these catalysts lining up that should continue to pressure bond yields, at least keep bond yields at bay. I don't think we just out of nowhere rip to a new cycle high, which I mean maybe we could do it tomorrow on PCE, but just now having 3 lower highs from the cycle peak, and then 3 days ago another lower high, and then today another lower high in the 10-year. I'm sure probably MFR will show lower highs in yields tomorrow, and looking at Raphael's signal, which has been really helpful on bond yields for me, it's looking good from below his trade signal, and we just need to put in a test of that trend level. And so I think catalysts can push it there in the near term, and so that affects the type of assets that I'm allocating to right now. And so for me, I am uncertain on what direction equities go here. With us just pinning 3,800 today, it could go either way tomorrow. It's pretty much a coin flip of if we break 3,800 or if we just pin again or if we bounce up to 3,900. It's a crapshoot either direction. So my portfolio right now is completely neutrally hedged to the market. So looking at like a correlation perspective, I have no correlation directly to S&P, NASDAQ, and the Russell. Like if you're just looking at a correlation basis, I have no correlation at all. And the way I'm doing that is on the short side, I'm overweight mid small cap cyclicals. So I like a lot of inflation beneficiaries on the short side. For example, a big one that I have on right now is MOO. That's all the agriculture equities. I have that in the short side. I've gotten a lot of cyclical REITs on there, so a lot of things in the residential sector like Camden. I've got industrials on there, Russell Value, mid caps, and then some cyclical consumer discretionary. So leisure names, reopening names, a lot of that. The big theme on the short side is just I'm not interested in shorting tech or NASDAQ right now. Just not interested. I mean, I know people say that, you don't buy NASDAQ because bond yields are going down, but that narrative is pervasive. And if bond yields crash and if equities bid on that, the things that are going to outperform likely is going to be tech and growth related equities on that. And so, and you even saw it with FANG being up pretty big today on the day. And you're starting to see like FANG signals strengthen in relation to mid and small cap signals. So you had the Russell pretty much go no bid today, but then Facebook, Amazon, Apple, Microsoft all up almost 1.5% today. So you're getting some people going to those names with bond yields going down, and so I'm just going where the trade is and just not interested in shorting Qs, not interested in shorting tech. The only thing on the tech side I am interested in staying short is crypto related stuff, because that stuff is less likely to bid in a squeeze. If we get an equity squeeze because bond yields are down, I'd say it's more likely that NASDAQ goes up and not over, MSTR, Block, ETH, Bitcoin. Just because of all the problems in that space right now and people are so scared of it, I think it's less likely to catch a bid than those names. So that's the only thing I'm short in the tech space. And then on the long side, I'm long a lot of I'm pretty much just a stock picker on the long side right now. You had some names that were able to get back to bullish trend through that squeeze, and they're across the whole space. I mean, one of the big ones in the tech space is Zoom. That one's bullish trend. Had a pretty okay day today. Bought some more. Got that one sized up. IBM is just a beast. I mean, that thing just like can't go down in on big down days. So that's on the board in the tech side. So I do have some tech exposure on the long side, but I'm hedging it with larger cap cyclicals on the short side. So things like Kroger, which is a low beta staple, but large cap or large to mid cap. I have that opposite an IBM or a Zoom on the long side. And so I'm doing it that way. And then otherwise on the short side, I'm just keeping small caps on here because, if we start getting more pressure on bond yields today, but equities don't want to go down, I think you're going to start getting more days today where you get the Russell significantly underperforming and maybe S&P and NASDAQ flat to even potentially up. And then you might get Russell flat and NASDAQ up, and the Russell could just very well not participate in the squeeze from here if we get that pressure in bond yields and you don't get that kind of reflationary action with in a squeeze where you get bond yields up and then stocks and crap stocks up on that. That would probably hurt me pretty badly. But I think that's unlikely because we have these catalysts that should keep that trade at bay for now. So we'll see how it works out. But that's the perspective I'm having overall. Like portfolio volatility is pretty much in line with the S&P, adding up my longs and my shorts. So not taking on a crazy volatility here, but am pretty much hedged short, long, short across the board in that format. And so we'll see how it goes. It worked out really well today, you know, in a flat market, generated some big returns because you just had the Russell go no bid versus, you know, my longs, some were even up today. Names like some China names were up, JD, you had LW, a staple, Aldi Bargains, the little you know, cheapo outlet store that was up, Verizon was up. And then alongside equities, I still have the bonds. You know, I know last week I said I don't have any opinions on the bonds. I didn't know what was going to happen. That was the day after they just ripped face to a cycle high after the Fed meet or before the Fed meeting. But I held on to them just because, you know, everything is lined up from a fundamental perspective, in my opinion, for them to work. The signal, it's not good. I get that. I mean, I look at my signal strength every day. For example, BAV 0.24 signal, BNDX 0.24, gold 0.39, VGLT, same thing as TLT, basically 0.4. So these are not impressive signals. So I don't own these at all from a trend following perspective, and not owning them from a trend following perspective, I admit, has been a poor decision for the last 6 months. And we've gotten these opportunities where they could work. It hasn't worked yet. But I think the fundamental landscape right now with us, you know, moving more into recessionary talk and the way they've behaved, especially over the last 2 weeks, kind of through this drawdown and through this equity action, I think is really impressive. And I think you can't really ignore bonds here, and definitely shouldn't short them. So that's my perspective there.
Yeah. Hey, can I butt in, Vi, real quick? I wanted to just say that I completely agree with Brian on the tech side. I think that it's better right now to start focusing on these commodity shorts and leave tech alone, because tech's, you know, the game's been played in tech, and they may have some more downside, especially in the big tech area. But really moving over towards, like Brian said, is maybe starting to build positions in long-term bonds, as well as starting to build short positions on the commodity side, is probably going to be where the next game is played.
Yeah. I mean, all you have to do is look at just simply the U.S. sector ETFs and how they performed today. You had XLF down 75 bips, XLB down 70 bips, XLE crushed, XLI down 0.6%, and XLRE, which has a lot of cyclical REITs in it. It's actually less like longer duration REITs, down 0.6% versus tech, healthcare, staples, utilities, and comms all up. So that keeps continuing. That's like a big pain trade for people because they all chased inflation beneficiaries and industrials over the last 6 months. And if the reality of these ISM prints, especially the manufacturing one on Friday, starts coming to light, I mean, you know, these still have a far way to fall. You just look at the chart of like XLI, for example. I mean, that one in relation to the NASDAQ, which has gotten absolutely crushed, I mean, it's well above pre-COVID highs still. And the situation pre-COVID is obviously even worse than now. So, you know, I think those are the lower risk equities to have on the short side. And they have even more, I think they have more downside than the NASDAQ. And then if they do squeeze, then they're going to go up ideally less than the NASDAQ. So I think if you're going to play the short side here, it's via those names for sure.
Yeah, absolutely agree. And yeah, in this moment, bonds are definitely not a short. Even it doesn't matter, but I'm very bearish on bonds in the longer term still. But that's the main reason why I'm not touching them for the last more than 2 months, because a lot of factors play in, and from the signal perspective, even though trend is still bearish, well, of course it's bearish because bonds fell a lot in the last 6 months, but from all other perspectives, especially correlations and momentum, now bonds are not a short, and if you have fundamental reasons in the short term, maybe even long bonds can play out. Yeah, you were talking about commodities. All commodities look terrible. I see no longer signals in commodities at all. In the short term, only palladium looks good, but still uh, only in the short term. In the mid to long term, when we are talking about 3 weeks or few months, nothing looks good on the long side from commodities. Uh, okay, Rafael, your turn. What are you trading and what do you see in the market?
Hey guys. Basically, what Matt and Brian said, I mostly agree, especially regarding patience. It's definitely something very important in this bear market. Sometimes it's a little bit boring, but it's definitely more boring than bull market. But it's better to wait than lose money, right? So compared to the last meeting we had, so I think we were pretty bullish relatively. I mean, the bet was where the VIX was going to go down. So if you look at where the S&P is now, it worked. I mean, we got the move up. I noticed that the 21st of June, the short-term correlation between bonds and equities went negative again, and boom, voila, we get the move up in S&P, Nasdaq, etc. So there's definitely something there, something quite interesting. The only difference this time is that I didn't wait for a retest of trend. I decided to actually start to short when I chose the Nasdaq. When the Nasdaq touched my trade line, so the volatility trade line, and pushed bigger yesterday actually on the short side pre-market, which was very good. I mean, I'm more and more amazed by the fact that the bounce are less and less potent the more we move forward in time. I mean, we used to have like a plus, I don't know, 15% move, and now we barely get plus 5%. If we touch the trade line, it's already very impressive. So I started to come back. I let go of my long Nasdaq and actually switch short to Nasdaq. So definitely my mind is more bearish than I used to be 2 weeks ago. But still, I have a big cash position. I'm trying to be very patient. I'm trying to learn how to trade this market. I'm not used to bear markets. They are very rare. So I'm trying to be humble and to understand how it works. One thing I did was increase my short Euro USD position drastically. So basically, I think it was the 16th of June up to the 27th. I added almost every day to the short, and the 27th actually it retested my trend signal and also MFR trend signal because it went bullish for a few minutes, I think, indicating that it was trying to switch. Obviously, if you think dollar should go up, euro should go down, it was a perfect spot to go big. So I made it my biggest position and it worked perfectly. What else? I'm playing around with KWeb, with China. It's small positions, but I'm loading anytime we have a down move. It's the long position I have. Regarding yields, so I agree it's not a good time to go short bonds as it could have been before. I still don't know if we're gonna get the break of trend. For now, I'm still in the camp of probably the yields moving from trend to trade and just staying there until my momentum indicator finish to do the full cycle, basically indicating that we're gonna get the next move up in yields. So that's my thinking now. Yeah, I'm monitoring for equities. I'm monitoring the correlation between bonds and equities. Until now, it has indicated always a bear market rally. For now, we are still negative, even though bonds are working and equities are going down. Today was actually a no continuation day. I expected the market to go down more than it did. So with the correlation not flipping back to positive, what does it mean? Does it mean that maybe the bear market rally that started the 17th of June is not over? Does it mean something else? I don't know yet. So I'm trying to be neutral regarding equities with a little bearish bias, trying to trade currencies more. I think they deliver more clear signal, and definitely keeping a very big cash position. So I want to observe. I want to learn. I want to see if we can get finally the real bear market rally we are all waiting for.
Yeah, nice. If that helps, I can say that US 10-year trend is below 2.9, so basically above 2.9 it will still be bullish. And TLT, for an example, for it to not be bearish, well, it needs to go way above 120. Of course, that signal can change. These values are for now, so when time passes, it can change. But yeah, so we are still quite far from signal from very important levels, at least in my model.
Yes, one thing regarding TLT, by the way. So Brian, you have access to it, so you know. But it's I have it as a bullish trade, and the signal is pretty clean. So meaning Vi is right not to short bonds, and this move that we are seeing in TLT and others, it could last. The issue is, will it be range bound trading? Basically, we go from the top to the bottom of the range for several weeks, or is it really the start of something that could move from bullish trade to bullish trend? This remains to see. I don't want to make supposition about it. So, but it's a good signal. At least it's bullish trade.
Yeah, and for shorter term, I mostly use momentum scores. Those scores that I tweet every day on Twitter. For now they are not available in MFR. Hopefully, we will add it soon in the future, but we'll see. But for shorter term, yeah, absolutely agree what you said, Raphael, because in both 5 and 10 day momentum scores, TLT is positive. So yeah, absolutely, that's another reason why it's better to not short those. And in 30 days, it is quite mixed. So that momentum is, you can call it neutral, basically, because it's negative, but very slightly. So I would call it neutral because it has no specific momentum now. Okay, so if you all remember, 2 weeks ago, I was all about patience, all about not rushing to trade those markets, because the signals were very mixed, and volatility was quite high, but at the same time the chop was there. So 2 weeks ago I was very concerned that the best idea is to not short those markets, and actually patience paid off, because SPY is approximately 140 basis points above from where it was during our last phases. So yeah, but actually during these 2 weeks I did quite a few things. I even shorted some gold last week. It was fun, but I closed it because gold looks terrible, but at the same time it's very choppy. So basically price momentum goes down, but those wicks and spikes basically. So basically, I kept it for 2 days last week, and closed with a very, very small profit, almost break even, because I just didn't like what the first exponents and the price action itself were saying, because yeah, even if the gold went down, but how it went down, it was just a chop. So my signal just said that it's not tradable. So I'm not short gold anymore, but I'm definitely not bullish on gold at all. Some macro guys say that gold is a good idea to have. I don't think so. But of course, signal can change anytime. But from my perspective, I just don't like it. So I remember that I'm not buying gold even when it's a bullish trend. I just skip it, basically. So in most cases, I don't have gold in my portfolio. But yeah, last week was fun because I was shorting it a bit. Okay, and also I added another spread. I will talk about it after I will tell you all the numbers and all the signals from the signal perspective. Yeah, but basically now I have two spreads instead of one. So I still have XLU IWM, and these weeks that worked quite well. Well, at least in the last days it worked quite well. So now that spread is up quite big. We're talking about 200 basis points in profit, but my goal, if signal doesn't change, and the funny thing is that that signal didn't change for months now, if you remember, but my goal will be, especially if we go into a recession or we will have another strong leg in a bear market, strong leg down, my goal would be a lot higher, maybe new cycle highs, or even where the spread was in 2020. So, of course, it's just the goal based on current signal, and signal will change for sure. But I plan to keep that for quite a long time if the signal doesn't change. So it's not like I entered XLU IWM and I will sell it just now just because. No, I plan to keep it because signal is the same. I will talk about my second spread a bit later, but yeah, okay. So as Matt said, I'm also quite bearish on the overall market in the longer term, but in the shorter term, basically nothing changed from 2 weeks ago. I don't see a point in shorting this market now. Because a lot of mixed signals, and there are a lot of things that you actually don't want to see when you are shorting. So first of all, of course, I will talk about the correlations as always. So equity bond correlations are negative. So, we can call it quote unquote a more normal regime. So basically, it's not good for shorts. It tells us that there is a probability of the market not falling that much in the shorter term, or of course, as Rafael said, Rafael also mentioned that. But for a bounce, I still think that we can see 39.60 or even above 4,000 in SPY. We'll see. Of course, how it goes, but I'm not shorting the market here. So on a 5-day basis, SPY to TLT is negative 0.47. On a 10-day basis, it's negative 0.4. And even on 30-day basis, it's negative, but very slightly. It's minus 0.1. So yeah, but it's still negative across all the time frames that I post. So. The conclusion about the sectors is basically that correlations are high. The correlations are high still, but lower than it was. That's not what we want for short. So risk is not building up here still. There's no capitulation. There's no rush in the markets and so on. Cross-sector correlations are also lower, relatively high, but still lower. Cross-sector correlations is basically when you take all the SPY sectors and calculate their correlations and take the average. So currently it's below 0.7, which is, if you take a lot of years of data, it's relatively high, but compared to where it was during all those bear market rallies, it's lower. So that's one thing why I don't want to shorter markets now, and that's why I think that risk is still to the upside. And we can see that, of course, if signal changes, I will let you know. Of course, I will tweet. But also the momentum. I don't know if you noticed, but in a 5 and 10 days, things like SPY and so on, they have a positive score. So you don't want that if you are shorting the markets outright. Yeah, so that's about the main assets. I call them SPY sectors and other stuff. So yeah, of course, both stock bond correlations negative. Cross sector correlations are not too high. Let's call them not too high. And short-term momentums are positive. So this one. Okay, so now let's move to developed markets. This one is actually quite interesting, especially in the short term, and it's related to the spread that I opened. So if we talk about the correlations, in 30 days, nothing stands out. Basically, everything is quite highly correlated to SPY. But where it becomes interesting, it's in a 10 and 5 days correlation, because EWH, which is Hong Kong, I know that Matt and Brian were talking about China, so I'm not trading China, but actually now I bought EWH for a lot of reasons. Of course, I didn't buy the directionally. I combined it into a spread against EWO. I will tell you why. Yeah, so my new trade spread is EWH versus EWO. I opened it on Monday, and for at least for now, it works extremely well. So in 10 days, EWH has 0.67 correlation to SPY, which is one of the lowest developed market correlations to SPY on a 10-day basis. But on a 5-day, EWH is only 0.32 correlated to SPY, and it was lower. It was 0.29 today, 0.25, I believe, on Monday, when I decided that based on all the signals, it's a good time to play that. So yeah, from developed markets, EWH stands out from the correlations perspective, and why EWO. So now from correlations, we can move to the momentum. So that's the main reason that EWO has very strong negative momentum across all the time frames. So we are talking on 5 days, negative 0.47, on 10 days, it's negative 0.49, and in 30 days, it's negative even more. So that's why I decided that I had EWH, EWO in my watch list, and then I calculated the ranges and trends not only on those assets and on the spread, and I pressed the button. So yeah, developed markets, EWH from the long side. But of course, as I always was talking during those phases and so on, in bear markets, you don't want to be long equities directionally and not hedged. So yeah, it's all about relative performance when you trade spreads. So that's why I combined it with EWO. Okay, so that's about the developed markets. So from emerging markets, I have no trades, but I'm monitoring very closely FXI, which is China. Yeah, and Matt was talking about China and so on. But I don't think that I will trade that, because I have Hong Kong now, and those things are quite highly correlated. So I think that my view on Chinese equities will be, I will express my view using Hong Kong. That's all. From commodities perspective, like I said, nothing is bullish in my opinion. I don't like any, basically I like nothing on the long side. Palladium looks decent in a very short term, but then when you watch higher time frames, no, it really doesn't look decent. So I'm not pulling the trigger. Yeah. If you call dollar commodity, I know some people do, so I will put it here. So I still like dollar a lot. That's why when I say that I'm 80% in cash, it means I'm in dollars. But as you know, I'm from Europe and my accounts are denominated in euros. But I keep everything in USD. So basically, that for people in the US, it's not a trade; it's just holding cash. But for me, it's not only holding cash; it's the trade at the same time. So yeah, I like dollar. Nothing changed for months. I'm still quite bullish on dollar. So yeah, and for the short side in the commodities, so I have quite a lot of candidates for in my watch list. For now, I'm not shorting those because I would like to combine them with some pairs, but I don't see good candidates for me to add to the long side. That's why I'm still having them in watch list. But basically, if you want, I can tell that from commodities, the most bearish from all the signal perspective combined score, basically BAL, copper, corn, and wheat. Basically, those things are looking very terrible. And of course, gold. Well, gold is a currency, but as I mentioned, gold looks terrible from signal perspective as well. But I don't like gold because it's very choppy. I mean, it can spike based on anything. I mean, yeah. So for now, from Hurst exponent perspective, gold is not tradable for me. Yeah, but if for some reason you want to buy now, if you're holding gold from before, yeah. So of course it's up to you from risk management perspective because it all depends on your horizon when you entered and goals and so on. But if, for example, you plan to buy it like today, now it looks terrible. We'll see if the signal changes, of course, then there will be another story. So yeah, these are the news for me. 80% cash, and now I trade not only XLU, IWM, but EWH versus EWO. Yeah. Okay.
Hey, Vi, I have a question on Hurst exponent. I finally got around to adjusting my sheets to get that data coming in from MFR, so I've been taking a closer look at it recently. One thing I noticed when I plugged it all in was, there's a pretty starking difference, between asset classes on Hurst. So like within equities, you have SPY and Qs showing a 0.6 Hurst on the 3 month, but then IWM is showing a 0.7 on 3 months. So you got IWM with a higher Hurst there, and then across dollars, bonds, and then commodities, so copper, oil, and then I'm looking at DBA. They all show a 0.7 and above there. And so is that kind of like, how do you, how differently would you trade something that shows a point above a 0.7 Hurst versus, SPY and Qs right now showing a 0.6 Hurst? Does that mean they're more likely to kind of go whatever way versus sticking to the trend? How do you view that?
Yeah, good question. I will expand on that, and actually, I will also tell the definition of Hurst, how I think of it, which is not exactly what other people think of it. Maybe some people even will say that, oh no, it's not a good idea to think of it this way. But for me, it works quite well. So yeah, of course, Hurst shows persistence. But you can think of it as, for example, as a delta in option. Also, a textbook definition of delta in options is, of course, how the price of an option changes when the underlying asset moves. But all the options traders, say that basically, delta is basically what is the percentage probability now that this option will expire in the money. So I think of it. I have my own definition of Hurst, how to think of it. Also, and maybe it will make it for listeners. Maybe it will be easier this way. You can think of Hurst the following way. Basically, let's say it has 0.7 Hurst in a 3 month horizon. So you can put the definition the following way. based on 3 months data, there is 70% probability that tomorrow market will go to the same direction where it went today. So basically, if it's trending, so basically, it's not. Some people still confuse it. People think that 3 month or 1 year Hearst tells that most likely the market will go to the same direction where it went for the last 3 months. No, not at all. Basically, no matter what the time period for Hearst you use, basically the main difference is the more data you use, the signal just becomes based on more data. So that's why those numbers differ, and different periods are included and so on. But it doesn't matter if it's a 3 month Hearst, 1 year Hearst, 4 year Hearst, and so on. If you get a number, you can say that based on this X period of data, there is Y probability of the market going to the same direction where it went. So if, for example, today the candle was red, you can say that a trending asset most likely will go to the same direction. Well, not most likely, but I mean the probability is actually Hearst, and it's not the popular Hearst definition. Let's call it my definition. But how the question was how I would trade it, so it's quite easy. There is, you have access to the ranges, momentum, trend, and so on. So, for example, when you have a book, then you have a trade for how to think of it. The higher the Hearst, the less you want to, day trade, because maybe there is more potential on the table. So, if an asset is really trending, when you have a good place to make a trade, so for example, you want to buy something, it's at or close to the low of the range. It's in a bullish trend. Momentum is positive. Correlations also tell you that it's a good idea. So the overall picture is good idea. If it has high Hearst exponent, so maybe you just, if you enter your position, of course, based on your sizing, never oversize, but maybe it makes sense to let it run for a bit longer. And for lower Hearst exponents, maybe it makes sense to trade the range. So basically, if you bought it and the next day it went to the top of a range, you just sell it, because most likely it will soon it will be at the low end again, and so on. So that's how I would think. But the definition of Hearst that I said, it will never be the definition that you will find on the internet, because it's just the easier way to think of it. So I think hope it helps.
Yeah, that's interesting. So basically, what you're saying with if a Hearst is a 0.7, you think about it. If the thing was up today, it's got a 70% probability that it'll be up tomorrow, basically.
Yes. Yes.
So does that mean that if you have something that's up and down, that's what drops the Hearst? So that's kind of what we're probably seeing in SPY and QQQ.
Yes, correct, absolutely. Because the rescale range analysis, it measures persistence. So of course, if time series are not persistent, the Hearst will go lower, and 3 month Hearst will react quicker. So and it's not volatility adjusted. So keep in mind that one day it can go up 3%, and another day it can go down 1%, and it can repeat it over and over and over. And basically, then if you look at the chart, you will think, oh, this market goes up, but actually the Hearst will tell you that it's basically Brownian motion, because one day it goes up, another day it goes down, and so on. That's why, based on all the other available signals, I prefer to trade lower Hearst assets based on the range and the trend. So of course, so just buy it if it reaches top of a range, just sell it, and so on. And for the high Hearst, it means that there is a clean trend, not only in a chart where you see, oh, because some people think, oh, the asset is higher than it was 3 months ago, so it should be trading strongly. Well, not necessarily. Asset can be up, and it can be very choppy. Like, for example, gold during the last week, I mean, it went down, but even if you look at the candles, I mean, those wicks are just crazy. I mean, so yeah, and Hearst tells you that.
Yeah, that's interesting. So I guess like one call out in that, and I mentioned this more yesterday. Was about USO and how both oil and copper, they have pretty high Hearst, and so
Yes.
Using that type of information today, oil had a pretty sizable down day with still a 0.7 Hearst. So, it wouldn't be it would make sense if tomorrow that followed up with another down day because of that high Hearst.
Yes, of course. But as I said, probabilities, 70% probability is never 100% probability. Yeah. So you need to have all other signals in place, of course. Yes.
For sure. Yeah, it makes sense. Thanks, bye.
Okay, anyone wants to add anything before we start taking questions?
I'll go for it.
Okay, so first of all, I have one question which was sent to me. And actually, I want to encourage everyone, for example, if you can't attend the spaces or if you don't want to talk, but if you have questions, feel free when we announce the spaces, feel free to leave your questions as comments or in any other way. Yeah, so okay, first I will answer one question and then we will take your question. So the question is this: if main equity indices continue to deteriorate without correlations confirming previous biases, so equities having strong negative correlation to dollar and equity strong positive correlation to TLT, etc., how will you approach the data? Will you focus more on ranges, try to find new correlations, or something else? Actually, it's quite an interesting question. No, I will not try to find new correlations, that's for sure, because, but if, for example, if you see that, like we had last week, and even a bit of this week, for example, indices go down, but correlations from all the backtest and theoretical perspectives doesn't confirm that. So how I approach is quite simple. First of all, as I said, I can maybe trade the ranges, but only for the very short term. So basically, how I approach it, I will not short that because you cannot catch all the moves. Because markets, first of all, are choppy markets. All the signals are changing every day and so on. So basically, for me, if, for example, equities have negative correlation to TLT and markets are going down, if I already have shorts, maybe I will reduce the position, but based on other signals, I can keep it, but I will not add new ones. And actually, this question has some, well, not misunderstanding, but actually, what you said, equity is having strong negative correlation to dollar, and equity is strong positive correlation to TLT. Actually, it's a very bearish signal. So, I mean, if markets are falling and equities have strong positive correlation to TLT, so I mean, it's exactly what you want to see if you are short the market. Yeah, but let's say I will answer it based on what we see now. So markets are falling, but SPY TLT correlations are negative as an example. So basically, it just stops me from pushing the short button. That's why. So no, I will not try to find new correlations. And yes, maybe from time to time I will focus more on ranges. But if all the other signals are good, so for example, of course, bearish trend, top end of the range, and so on. But correlations doesn't confirm it, so I can take a trade, but I will be ready. Basically, I will monitor it and will be ready to close it at any time, even sometimes during the same day. Because for me, in my process, and from of course personal trades and mistakes, I mean, best trades happen when all the signals align. And if you miss one thing or if you ignore one thing, yeah, you can still catch a good trade and so on, but there will be mistakes. And my worst trades in the period when I already had this model, because of course all my worst trades were years ago when I had no process. Of course, I was trading forex and CFDs with leverage. But if we are talking about the period when I already had those models and processes, basically my worst mistakes were when I ignored something. So that's why now I want everything to be aligned. And with everything to be aligned, I mean correlation supporting the trade, momentum supporting the trade, of course, trend. Well, trend is the most important, but all others are also important. Trend, range, hurst, basically everything. Yeah, so that's why, you know, sometimes in bull markets, actually, then you get a lot of signals because, you know, a lot of assets always show all those things and you are very happy and you are just trading. It's quite easy. But that's why in their markets, when the chop increases and everything, uh, there are quite a few periods when basically, like it was 2 weeks ago, and somewhere I mean, I see that signals don't line up, and basically it just tells me not to trade. And yeah, like uh, Matt and others were talking in the beginning of Spaces. Yes, cash is a position. Some people think that you always need to have some equity or ETF or fixed income trades or whatever. I mean, cash is also a position. Yes, okay. Hope I answered the question. Okay, so if anyone has a question you want to ask, or maybe not a question, maybe you want to add something into a conversation, feel free to request to speak, and we will do our best to answer. Or
quickly, right? So you mentioned you didn't short, at least you didn't add to the to short. Was VIX ratio part of the reason you didn't short? Because currently it's basically in the middle of the range. I remember in the previous shorting opportunity at the at the beginning of June, this ratio actually had upside downside ratio very small. So we were sticking to the top of the range, but now it's in the middle. So did it play a part in the fact that you didn't add two shorts?
yes and no. I will explain why. Because actually, yeah, upside, downside, and the range itself, yes, it was one of the reasons, but not in a way you can think of, because the VIX ratio is going down, and as we all know from, you know, the past, this ratio is positively correlated to the SPY index. So basically, actually, VIX ratio going down is quite bearish for stocks. But yeah, I know this upside, downside, and the range, yeah, is one thing that keeps me just another check box that keeps me from not shorting it. But in this level, it's very oversold also. So I will say that well, usually when this ratio is going down, it's good for shorting the markets. But now it's very oversold from my momentum perspective, from all other indicators I use. So it can bounce, of course, oversold. It can stay oversold for long periods of time. But how I view volatility is not only this ratio, but basically one thing I want to mention, and I didn't mention this because today, because we were talking about it all the time, especially Raphael likes to talk about it. VIX below 30 is also one thing that, I mean, is not very good for shorting the market. at least from my backtest and then from my perspective. So VIX below 30 is one thing. Oversold VIX ratio is another thing, but some time ago it was going down and was not oversold. So actually it was, if I had a sheet with reasons to go short and reasons to not go short, falling VIX ratio would be in the column where reasons to go short. Yeah, but other things stopped me from that.
Thanks, man.
Okay. Yeah, sure. Yeah, and yeah, always monitor the VIX and the VIX ratio. It's very important, of course. Okay, so I don't see any questions, so let's wait for a few more minutes, and if we don't get any questions, then maybe we can do bets. And Rafael, you have ideas for bets?
I will find an idea.
Okay. Yeah, let's wait for questions for now. I don't see it.
Do the 10-year. Do the 10-year.
Yeah, I was thinking about the 10-year actually. Yeah.
Okay, so maybe we can do a bet. That's what is the question for a bet, and we will place bets. And if no one asks the question, we will just finish. Oh, okay. I see one.
Okay. So let's wait for the question.
Yes. Steve Capital, hi. You can ask a question.
Can you hear me?
Oh, yes. All good.
Hey, just so I want to thank you for hosting this. Hey, just want a quick question on European credit market. So I mean, I've been kind of monitoring the European credit stress for a while now. It's quite interesting to me. It's like, so I'm looking at the high yield option spread. It's been going up since the Russian invasion, and it's been trending. And then I know the ECB is trying to do the 25 basis point, and maybe, I mean, I was listening to Lagarde this morning. She sounds very convincing that the EU economy is very strong, which I highly doubt it based on the data. So just want to get a take on what you guys think about the current European credit market. And I feel like something, and I'm just looking at some key credit indicators, something is cracking, but I don't know what it is, and based on a CDS spread. So just want to get some feedback on that. Thanks.
Yeah, no, I noticed I'm monitoring those. I'm not trading, so my answer will be, I'm not trading those, but my answer will be a bit different. Yeah, of course, I was also listening to Lagarde, and she's always like that. So basically nothing new, but from all the macro indicators in Europe, and because I'm from Europe, I monitor those quite a lot. So of course, inflation, sentiment, and GDP and the credit. I think that we will see we will see bigger hikes this year or in the beginning of the next year. I mean, of course, no one knows what will happen, but I think that the hope for ECB was that Powell will fix everything. Well, Powell will not fix everything, so I think that they will have to admit and to start raising more aggressively. That's my thought. And then based on this opinion, so it basically tells you my opinion about the credit situation also, because I don't think that 25 basis points can fix the situation. And yes, things in Europe are cracking, especially in the south. So I don't know how Lagarde can be that convinced and say that economy is strong when it's not. So I don't know. Maybe others have something to add.
Yeah,
Raphael,
I mean, it's a game of pretend. I mean,
yes,
it's just the things they can project confidence, and magically it will fix the situation. So yes, definitely cracks everywhere. The only question is timing. It's always about timing. So if you go too early, you get wrecked. If you go too late, you miss the trade. So yeah. But the situation will worsen. I mean, we've been talking about this since what, January, February. So of course, it's not the end of the bear market. A lot of dominoes still need to fall. So yeah, I mean, you're probably not early, and you're probably not late.
Yeah, well, yeah, because I've been trying to, take a, larger position on the short side, but, I know Bridgewater have a big chunk of position, and they're trying to talk their book. So I know this is best time to, to jump on the boat. But it's just interesting. I mean, I know you have the rate decision coming out tomorrow morning, right, at the Seek Bank, and then tomorrow you also had the unemployment rate. That's something that the ECB is monitoring. So, I mean, there's kind of interesting. Also, the CPI is coming out as well, right? The EU CPI on Friday.
Yeah. Yes.
So I think these couple data points is going to create some near-term, volatility, as well as the outlook for next month. But I mean, she sounds very convincing on the 25 basis point. I know it's not doing anything, but I mean, they're saying, I mean, in my opinion, I think the EU economy is so fragile. I don't think they can handle one basis point hike. But I guess we shall see.
Yeah, we'll see. And yeah, the direction of your trade that you're thinking is the same as I would do, of course. But no, don't take big positions. I mean, I don't think that it's a good idea.
All right. Okay. Thanks.
Yeah, you're welcome. Okay, so let's place our bets. And if you still have any questions, feel free to ask. Raphael.
Yeah, so the bet for the next 2 weeks. So first we have to go back to the bet we did last time. So it was our low was VIX going to go. So Brian won this one. We were too bullish, by.
Yeah.
And so for the 10 years, the bet can be, will we see the US 10-year go neutral trend? Would you like this?
I don't think that it's a good bet for one simple reason, because I know when at what level it would turn. So I think that it's not a good bet.
Okay. So let's say how low will the US 10-year go? All right.
Yeah, that one is good.
Or Raf, do it whether it breaks your trend line, that 3.01 for like a day and closes below it.
Okay. Yeah, we can.
Okay, yeah, we can do better if it breaks 3.01 during the next 2 weeks.
Okay.
Yeah, and has to close below it.
Okay, tough call. Okay.
Yeah, but it has to close. But it has to close below it at any day, not necessarily when we will do our spaces, right?
Yeah, in the next 2 weeks.
Yeah, sure. I think that yes.
I say yes.
I'm checking because it happened before. It happened in the beginning of March. Yeah, definitely. Okay. It's
okay. So all three, yes.
3. Yes.
Yes. Okay, so I think that's enough for today. Hope this was useful. And as always, risk manage your portfolios well. And if best advice would be if you don't feel comfortable about entering or holding some positions, best is always to keep the cash if you are not certain about some things. So yeah, thanks Brian, thanks Raphael. Matt has already left, but also thanks Matt, and thanks everyone for joining. And we'll see you in 2 weeks. Bye.
Bye, guys.
Bye, y'all.